When you make a traditional mortgage payment, it often feels like pouring water into a leaky bucket.
Oh, yeah, definitely.
You put your hard-earned paycheck in every single month, but that massive front-loaded interest just drains your wealth right out the bottom. So, welcome to the deep dive.
Today, we're looking at a product that claims to actually fix that leak.
Yeah, we're unpacking the Loan Store's Wealth Builder loan. We've gathered their operational demo video, an internal FAQ, and their actual underwriting guidelines. We want to figure out if this is basically a financial cheat code for you or just a highly specialized tool for the really disciplined earner.
Well, to understand why this product is turning heads, we first have to look at how it radically changes the daily behavior of your money. The core feature is a linked checking account.
Right, so instead of a standard 30-year fixed mortgage, this is basically a first-lien ELOC, a home equity line of credit, just sort of mashed up with your everyday checking account.
Exactly. When your direct deposit hits, it's swept nightly to temporarily reduce the loan's principal.
So let's update that leaky bucket analogy. This account is more like a reservoir, right? Your paycheck fills it up to drown out the daily interest.
Yeah, but you can still open the dam whenever you need to pay your credit card bills or buy groceries. That reservoir mechanism is crucial because interest on this loan accrues daily, not monthly.
Oh, wow. That's a huge
It
difference.
really is. Every single dollar sitting in that account lowers the interest charge calculated for that specific day.
The numbers in their demo video really highlight the impact of that. They ran a scenario with a $700,000 initial draw.
Right, and by simply routing regular income and living expenses through this linked account, the borrower pays off the home in just 11 years.
11 years, compared to 24 years on a traditional loan. And the total interest to principal ratio drops from over 106% down to just 46%.
It's wild.
Wait, so just by changing where my direct deposit lands, I'm shaving 13 years off the loan.
It's a massive shift. It frees you from the oppressive front-loaded interest of a normal mortgage. But that speed relies on a structure that transfers the risk directly onto your personal cash flow.
Yeah, we should talk about the rules here.
Right. This is a 360-month open-ended structure. There is no fixed amortization schedule dictating exactly what you pay each month.
So for the first 10 years, your required minimum payments are just interest only, right? Based on that daily balance.
Exactly. Then, in year 11, your available credit limit begins to gradually decline by 1/240th each month.
But looking at the rate structure, I have to point out a major catch here. This is an adjustable rate tied to the 30-day SOFR index, plus a margin.
Yeah, you're trading fixed stability for aggressive speed.
Right, so if you aren't highly liquid, a sudden spike in rates could trigger massive payment shock, because if SOFR spikes, your rate jumps.
You're entirely right to be wary of that. The SOFR index essentially reflects broader market interest rates.
Which means if overall market rates go up, your daily interest charge goes up right along with them.
Yeah, if you are living paycheck to paycheck and rates jump, that daily interest is going to eat you alive.
Because you don't have enough idle cash sitting in the reservoir to offset the higher rate?
Precisely. Because the risk of rate shock is so high, the lender essentially demands you already have a massive safety net.